Welcome to Rodriguez and Price,
He's Rodriguez, I'm Price.
the show about markets, media, and navigating the mayhem to come. In the studio, I have Tim F. Price, Esquire. How are you doing, Tim?
Very good, thank you. How are you doing, Paul?
Yeah, I'm doing great. How's the book sales going?
Through the roof.
Absolutely. Well, I had a look at Amazon before I came out, as I do, because you never look at your...
You're a tinker for Amazon.
I love Amazon. It's great, apart from the share price, which we'll come on to a little bit later. And I noticed that they've got you down as Price Tim as an author. I think you need to sort that out.
I'll have a word with Jeff B.
Jeff, and also there's only 8 copies left of your book, so you better
By now, all stocks last.
Exactly. Yeah, excellent. So, so how have things been, Tim? We're not allowed to talk until we come on the show, so I haven't spoken to you since.
Indeed.
Last time.
Perda, I think it's called.
Yeah.
I get the sense that markets are in a kind of like started to enter summer doldrums.
Yeah.
So there's not as much activity as I'd like to see. But I mean, I think the last time we were on, we were debating whether this was close to the top.
Yeah,
and we'll get onto that in a second.
Absolutely. Yeah, I think I put my colours to the mast and said, this is the top.
You nailed your colours to the mast.
I did, and it's just gone up further, which is typical. Anyway, so let's have a look. You've got some charts. I've got some charts. Fantastic. There's
So that was the first one,
on
and
so yeah, the
just powering ahead. I mean, what can you say?
And you high for the first time in a week. Is that slightly?
That's not one of mine. I'm trying to think who I liberated this chart from. It could
Okay.
either be Redburn Partners or possibly from Fuller Money.
Yeah. So what we had from a technical perspective is, you see that sort of emerging M shape before the rally up. That was a potential double top that went into something called an ascending triangle. So you should really wait for the topping signal. Most topping signals come out of a
head and shoulders
or a double top.
Yeah.
So we're waiting for that. As you rightly say, we haven't got it here on this Dow chart.
I mean, do you pay much attention to the Dow? 'Cause it's a kind of old-fashioned index.
Not really.
I mean, the components are chosen, subjectively by the editors of the Wall Street Journal, barons. And it's price weighted. It's very, very antique.
Yeah, I look at the S&P 500 and the Nasdaq pretty much, and that's about it really, and the individual components. But so that's powering ahead. But as I'll show you later, some of the European stock markets were doing exactly this before they then went into their topping phase.
Right.
And I thought we were in the topping phase for the American markets when we were last on. There was a bit more gas in the tank, but I still think we're very close. Although, can one short it right here, right now?
There isn't enough evidence yet, is there? Not in Dow.
Not on this alone, but with everything that we're going to put together today, it shows that there is some. So that's the Dow Jones that we've got, and what's the next?
Next one is MSCI World. So I'm not sure how many people look at this one, but if you're a global equity manager, this is effectively your default proxy because this is everything basically wrapped up. It's certainly everything in developed markets, and again, no sign of anything that's cause for concern.
Yeah, it's a very smooth upward trend, and when we look at the individual markets, you've got the Nikkei that looks like it's going up. The Hang Seng has been on a bit of a tear. You've got the Indian stock market that's been rising very aggressively. And within Europe, it's just a total fragmentation, and the US. So I think what's really driving this is a load of tech stocks from the US, and you've got various world indices that are powering ahead, and some should be, and some aren't necessarily, sustainable. But this does need more technical evidence, certainly, before one could say that we're in a global bear market. And so, what do we have next? We have a chart of the Glaxo.
So this is from the good guys at Redburn Partners, and they're looking at Glaxo relative to the FTSE All-Share, and you probably saw that AstraZeneca had a bit of a nightmare day yesterday.
Yeah.
So I think share price was off something like 16% at one point.
This is the problem.
And now, because we've sort of highlighted the expensiveness of Glaxo and AstraZeneca, and frankly, all of the big sort of global mega caps.
Yeah.
Very popular,
value there.
very widely owned. We would argue little value. They've been held basically as sort of bond proxies, so big dividend yielding firms, but the dividends aren't necessarily that well covered, which is something people aren't necessarily fully aware of.
Yeah.
I think a dividend cover for both is probably comfortably less than 2 times, which doesn't give you a lot of room for comfort. And so from the guys at Redburn, they're looking at Glaxo versus the All-Share, and their chart, I think, says it all. It just looks pretty ugly.
You mentioned the word bond markets. That's the magic word for me at the moment. They're all topping out. Government bonds are topping out. So this game that some companies are playing and buying their own stock, probably funding it with
debt, with cheap debt.
Cheap debt to make the numbers.
So what do you look at from a bond perspective then? What index or what price is the price you look at? Is it 10-year yields?
I look at the US 30-year, the US 10-year, the German Bund, German 10-year, the UK 10-year, and then look at short-term interest rates to see if there's anything there. And basically, they're all coming off. And the charts that you've been showing since we've
since we started, really.
Since we started saying these yields are just unsustainable.
Yeah, unsustainably low.
That's proving to be the case day by day. So the effect on the equity markets has been muted, and that happens at the top of a market because everybody's playing, they're still dancing to the music. Yeah. And as you once used the expression of dancing near the door, that's kind of how you've got to be in the equity market, dancing near the door.
But, I mean, of these markets, you're looking for bonds to lead the way. You're looking for basically a sell-off in bonds to morph into a broader-based sell-off in stocks.
Yeah, pretty much. Yeah,
but that has to be the nightmare. I mean, this is something that I've been worried about off and on really since '08, which is we've had this amazing bull run. We've had a bull run in interest rates that's lasted for 35 years.
Yeah,
you've had that's been consistent with a pretty much a bull run over the same period for stocks. So in an environment where there's nobody probably working in a dealing room, assuming there are dealing rooms still left in operation, nobody in a dealing room that's ever seen a bear market for interest rates.
Yeah.
And we've had the bull rally in equities has lasted for what, 9 years now? It must be one of the longest in history. And you think, so what if, the classic sort of private client portfolio will be 60-40, roughly 60% in stocks, 40% in bonds, increasingly indexed these days, so using low-cost passives and ETFs. What if both of those markets go into a bear market at the same time? That's not exactly a scenario many people are well positioned for.
No, and how else could you get things like Bitcoin going through the roof unless the value of money is zero or virtually zero? You just can't pump assets up like this without a whole-scale collapse in interest rates, because people forget, if you go back 15 years or so and you look at where interest rates were, you were paying 10% or above. 10% was considered low. So if you look at all assets on the basis of where interest rates are, house prices looked cheap so long ago, but they weren't cheap because you can't service the debt. The problem is, with an expression I've used is, with enough leverage, I could buy the world, right? And so leverage is the problem, and where the first signs that this is coming undone is not necessarily going to be in short-term interest rates, because the authorities are going to be slow to
completely squashing that.
Yeah,
right?
they're just going to hold them there. But the market is just going to be looking down the curve and saying, no, this is totally unsustainable. We're going to bail out. And then the bond markets start to lose control.
So your thesis would effectively be that the bond market vigilantes do have scope to run back into town.
Yeah, absolutely. Yeah, and it's happening now. So we're seeing some frightening jumps in yields that, if they continue, they will cause a lot of problems.
And on that basis, again, more from a fundamental perspective, does that suggest to you that we could then see a further iteration of QE that'll make all the other ones look like small beer by comparison?
I don't know. I don't know how they'll react to that.
Because the Fed's already started taking baby steps towards tapering.
Because usually they'll be sort of in the wrong. Even if they back away from that, is what I'm saying. It won't necessarily help. It's the market. The market psychology is, let's just buy everything and anything. Doesn't matter what it is, and it's very difficult for the markets to get out of that. And even if the Fed do change their stance, it may not necessarily have much impact in the psychology of the market for a little bit, and then this could be like a few months when the market's really falling aggressively. Then they may change. Then they may change their stance.
Because the way I describe it at the moment in relation, say, to equity land is, you've got, just anecdotally, quite a few high-profile companies are now coming out and disappointing. They're making some fairly poor earnings announcements. Well, and on the basis I described, it's like a sort of sniper's market. So it's not taking out everything, it's just sort of selectively taking out big companies one by one and just saying, we don't like what we're seeing anymore.
Well, overnight, what we saw was a big reversal in Amazon. So we had a massive
Which
move
is
up.
presumably one of the key half dozen stocks in the world today.
Yeah, so big reversal in Amazon, big reversal so a one-day reversal. So it's gone up and come straight down. Which
is that known as a key day reversal?
It can be, yeah, or a spike. So it spiked. So it remains to be seen what will happen. Apple did the same. Facebook was on a tear. Why all these stocks are up here, no idea. They're all coming off, and these are the signs. So let's look at the next chart, because I want to show you
now, this to my untutored eyes looks somewhat closer to a top.
Well, it is indeed. I mean, what we've seen here is virtually a 1,000-point drop in the DAX, and it hasn't got going at all. But if we're looking for a bear market, you've got to look for the main indices to start to turn over. So that the three indices that were doing very well were Germany, the UK, and the US. They were the last three standouts against Europe, and now they're turning over. So the DAX has definitely turned over. Now, whether it recovers, goes to a new high, breaks up, markets can.
Now, that line at the top there, which it looks to have just broken, was that a key support?
Well, that's a trend line. So that was a decent trend line, that a very simple trend line that we would indicate to begin the bear market. So that's broken. We've got a double top, and now that line at the top is the emerging downward trend. So from now we can say that the DAX is in a downward trend until it breaks that downward trend line. So the DAX, as far as I'm concerned, is showing a lot of weakness. It could be down to euro strength, which is the next chart that I want to show you. So this is the euro against the US dollar. Now, I've got this wrong in terms of I was expecting euro weakness and dollar strength, and it's just gone completely against me. But I think that this is over now, and we're at a very good level here at 117. It actually just spiked over it and came back down, which is what I like to see. So, you shouldn't really short a market when it's in such a strong short-term upward trend, but I think that the longer-term picture justifies, shorting it against this key resistance that's resisted it in 2015. So I think euro weakness from here, dollar strength, that may actually give the DAX a bit of a lift, because I think that's partly what's weighing on the DAX, but it also will weigh on the US stock market. So the fact that you've got dollar strength coming back in will put a lid on what we're seeing in equities.
But that's, having euro weakness would be consistent with what's happening in interest rates, because Mario Draghi shows no signs of budging on QE, whereas, as we've said, the Fed's already started slowly to start to tickle rates higher.
I tend to ignore what they say, pretty much. I know the market does look at it, and I know for discussing it on.
But to have kind of like the fundamentals matching the charts is quite interesting.
I think that's in terms of cycle. That sounds about right. It sounds like there's more froth in the US, so why are interest rates going up there? But moving on to the UK, where we had some GDP data. I don't know what your thoughts were on that, whether you actually looked at it.
Not really.
Not really, no. I just looked at what the headlines said, which said that it was much weaker than expected, and therefore the Bank of England may back away from interest rate rises, which is kind of my core view, that we're heading towards deflation, not inflation. But look at the FTSE, it's hit this high, which was at the 1st of June or the beginning of June. Towards the end of May, it was topping out. It's come back down, it's gone back up again. And this looks like it's making a major double top. Now, I know we're in the middle of that, so we do need to wait for confirmation. But that confirmation will be a break of 72.32. This is the FTSE future. I think this is September futures contract, so it's not the cash, because that's what I had on the CQG system. But this is no longer an upward trend. So you've no longer got an upward trend in the FTSE. You've no longer got an upward trend in the DAX index.
And the US is sort of, the jury's out there.
Well, you've had a very strong upward trend, but you've also had the key proponents of that upward trend
Started to weaken.
Literally from yesterday, literally from overnight, we've seen what looks like a blowout. So I think the summer of vol call is still on. You better have your phones
tin helmets,
onto core finance while you're on the beach. Keep a watching brief on the markets while you're away for August. So that's I think we're heading to a really interesting period, and this is the evidence that I'm looking at.
Would you be going short now, or you'll be waiting for confirmation?
You've got to wait for a bit more confirmation, but I certainly wouldn't be turning my back on this market right now.
Right.
Although it's the holiday period, I'd just be very, very careful. And the VIX vol has gone below double figures, so it's around sort of 9 something, and that's a good buying a good buying point. So that looks like a good level.
Okay.
Yeah. So what's going to keep us sane, Tim, while all this craziness is
we've been tossing and turning. We've been sort of batting forward some film ideas recently, and I have you to thank for. Quite objectively, the worst film ever made.
It is. Tim.
Run for Your Wife.
It's
2012. Danny Dyer, Denise Van Outen. Top call. It is absolutely atrocious.
Yeah, there's no redeeming factors.
And if you want a sense of just how appalling the thing is, just read the reviews on IMDb.
Yeah,
they're the funniest reviews.
They're brilliant.
Or it's more specifically, it's a barbell. So you've got the people out here who are giving it 1. And they've seen the film. And then you've got the people out here who've given it 10, and they're friends of the director.
Yeah, absolutely. You know, it's pretty obvious.
But in second place, so just bubbling up from under, would be this film, which is a film called Inseminoid.
What a great call that was.
I don't know if you've seen it yet.
No, I have seen it. It's you sent me the link.
These are all 3 separate sort of VHS video covers of the same film, but they give you some sense of just how appalling it is. I think, particularly the middle one, which is just too disgusting for words.
Yeah, it's just an alien rip-off. There's absolutely no excuse for this sort of film. Especially, I watched Planet of the Apes last night, which was the original, 1968. So there's absolutely no excuse. When was this made?
I think it was 81.
Absolutely no excuse for a film like this. But I enjoyed some of it.
Guilty pleasure.
Because it was funny. Which is you can't say that about Run for Your Wife.
This is true. Yes, it's just no redeeming humour whatsoever. And of course, the other question I have to ask: have you seen Dunkirk yet?
No, and I'm going to, because it's 70 mil. It's going to be absolutely brilliant. I'm really looking forward.
We saw it last weekend, and I have to say, not that I've seen that many films at the cinema this year, but it's without wishing to alter your expectations. But I'd say for me, it's a 10. It's an absolute 10.
I'm going to see it at the IMAX. I want to get the full
immersive experience.
Yeah, indeed. Thank you, Tim.
Thank you.
Great to see you as always. Enjoy your holiday. Don't forget, stay tuned because the volatility's coming. Thanks for watching. Good luck in the markets.